Joining me now to discuss all of this, Austan Goolsbee, President and CEO of the Federal Reserve Bank of Chicago. Thank you so much for joining me. I really appreciate it.
Thank you so much.
Well, it's great to see you. I do want to get your reaction to this jobs report. We just heard the breakdown from Christine Romans. This beat expectations that economists have. What are your big takeaways?
Yeah, look, it was a superb report. I thought Christine's analysis of that was spot on. And realistically, I don't think you can expect to get a better report than that, with strong jobs growth, the unemployment rate coming down, broad-based across multiple industries. But don't everybody throw the party just yet, because it's just 1 month report. And so even the jobs number itself, 250,000 approximately, that's plus or minus 130,000 margin of error. And it's only 60 days ago that we were getting unpleasant numbers that were disappointing, and then the market was jumping up and down and saying that the Fed needs to cut 75, 150 basis points by the next meeting. Now it's going the other way. We kind of got to take the longer view on this thing.
Okay, well, let me follow up with you on that. As you take the longer view, what are some key potential headwinds that you will be watching for that keep you up at night at this point?
Well, you look, it's kind of job of central bankers to not go to sleep at night. They stay up all the time. Nothing should happen that we haven't at least thought it through. The dock worker strike was on my radar screen for sure. It's a good development for the economy that we're not having that. War in the Middle East leading oil prices to go up. We've seen that movie before, and it's not a good movie. So we're going to definitely need to keep an eye on that. And as I say, there have been soft landings easier than this one, have been derailed in the past by those kind of external shocks hitting the system. But the overall trend, if you could have the inflation rate coming in at around 2%, as we have been having, and the unemployment rate floating just above 4%, as we have right now, with the GDP growth as strong, 2-3%, you would like to freeze that frame right there and put that picture on the wall. I mean, that's exactly what we would want to hold it at, and now we just got to figure out what's the best way to keep it in that steady state.
So you put your picture on the wall, and then you look at the polls, and the polls show the economy is still the top issue for voters all across the country. And they say they don't feel the impact of what is becoming a better economic picture. Why do you think there is still that disconnect, Austan? What do you think needs to happen?
Yeah, this is the question of the vibes. Now, when I became a sworn member of the Federal Reserve, you're out of the elections business. So the polling has, in my view, nothing to do, and the Fed decision, nothing to do with the election. If you look at the vibes, the Fed by law is required to have a dual mandate. We look at inflation and we look at employment. So we have to look at the real numbers, and we always paid attention to the vibes because they were a good leading indicator of consumer spending. As the vibes and the actual numbers have diverged, they've stopped becoming a very good leading indicator. So people are saying in the polls they think the economy stinks, but then they're going out and buying TVs and cars and going to football games and those kind of things. So I wonder if some of this is catch up to the data, and I wonder if some of it is a little bit everyone's own media environment, what they read about the economy, it is reflected in how they feel about the economy.
I do want to ask you about interest rates, because you have said that interest rates do need to come down a significant amount over the next year. After this type of a jobs report, this robust jobs report, what are you anticipating in terms of future cuts?
Well, I don't like to tie our hands when we got a lot of data that comes in, and we're going to have a lot of meetings between now and then. But my overall is that if inflation is where approximately you want it, and unemployment is basically where you want it, but the interest rate level is way above what almost anyone thinks where it's going to settle, you got to be careful doing that. Because if you're going to be that tight for too long, those first two parts that you like, they're going to deteriorate. So I think it's over the next 12 to 18 months got to come down a fair amount. And most people think that in the so-called dot plot where the members of the committee express what they think would be appropriate. But that's totally different than what should happen in the next meeting or the meeting after that.
And in terms of external factors, one that we're watching, obviously, Hurricane Helene, the impact of that, the recovery efforts that are underway right now in all of the different states that have been impacted. Could that have an impact around the edges?
For sure, around the edges. If for a given month you have seen hurricanes and other natural disasters wreak a little bit of havoc on especially jobs numbers, because the jobs number survey goes out in the so-called reference week. So if the damage and the cleanup takes place in the week they go ask, were you at work? It could affect our numbers, but over a longer run, given that this was a limited profile, I think the damage is going to be restricted to that area. It's probably not as big a macro impact.
All right, Austan Goolsbee, thank you so much. We really appreciate it.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app or follow us on social media.